October partnership tax. People talk about Mr. October in baseball. We talk about partnership tax in October. And bear in mind, boy, when you're having fun how quickly time goes, right? That this is our 6th meeting, which means, if you recall, on our 7th meeting, we have our exam, all right? So just keep that in mind. We'll talk more in a moment about that. So in terms of material, let's just bring ourselves up to date where we are, what we're doing today. So we have our general introduction, and by the way, I forget what the Trump tax proposal, but there's obviously getting more airing on this, but in the week that it's been released. But truly, if there's going to be a 25% tax rate associated with pass-through entities, truly, everyone here is going to, if you really have spent your Wednesday nights wisely, because you may become very busy as virtually every person you know decides that they're going to become a pass-through entity. What do?
They're going to quit their job and
they're going to quit their job, and we're going to be busy forming LLCs, 721s, left, right, and in between. We're going to see 721, 722, 723. We're going to consider 724. It's going to be the choice, the go-to choice, right? Because there is no second layer of tax. Now, there is a course, so I don't want to put a bad taste in anyone's mouth. There's a course that we're going to be offering hopefully in January on taxation of S corporations. I still subscribe to the notion that partnerships are more attractive, but a lot of people have S corporations. So seriously consider a little plug there, taking that course in the January session if you're interested in. Just people have asked me, the fall course selection should be out in 2 weeks, all right? And at least for now, those who are interested, we are going to definitely try to offer federal tax practice and procedure. All right, I see Diana's happy, Catherine. All right, very happy. Wish it was so easy to make everyone's day. All right, Professor Sapinski should be teaching the course, who has done a very good job in years past. All right, chapter 2. As I suggested to you before, something many of you in corporate tax are used to, this formation, and it is remember, it preserves the gain, right? It doesn't eliminate the gain. You can expect, and I don't mind saying this so that you study this, there could be a lot of questions on the exam next week, with a corporate formation, right? Both in the multiple choice and a short answer question where I have people contributing property, and I want to know, what are the tax implications of that, right? So you've got to know that. Everyone understand that? Don't, say after the exam, boy, you really took me by surprise. I didn't know you would ask a formation question. I will ask a formation question. How's that? All right? Everyone's got to know that. No surprises. All right? The one challenge here, but again, after the exam, we'll get more into detail, but you should have the very basics of what happens if you contribute property subject to liability, right? Akin to the Crane Doctrine / TOPS, it's considered an amount realized, there's debt relief, and it can, because you're shedding a portion of the liability, possibly result in considered a deemed distribution of cash, all right? So, but keep in mind, and in case I forgot, probably won't, but just in case, for the class after the exam, needless to say, we're not going to just go through the exam. Just a heads up, a little foreshadowing, that the next chapter, chapter 6, deals with partnership liabilities. Plan for our class after the exam. We will cover this chapter and get through up to page 215, just in case I forget to mention that. So for the class that follows the exam, chapter 6 plus the materials to page 215. Okay, guys? All right. So, and I did point out, and I'll repeat myself, that if you contribute services to a partnership, contribution to services, and you get back a partnership interest, and it's a capital interest in the partnership, generally it's taxable, right? Generally taxable. In contrast, if you contribute services and you only get a profits interest, barring extraordinary circumstances, generally not taxable, right? And that's in the corporate tax area, the same sort of rules apply. Right? And towards the end of that chapter, we talked about organizational expenses, very similar to Code Section 195 and 248 in the corporate realm. This time it's in Code Section 709, and only $5,000 can be deducted. Anything above that amount, you have to amortize over 15 years, and if you exceed $50,000 of organizational expense, for every dollar you exceed $50,000, you lose $1 of immediate deductions. Right? And we talked about Chapter 3, operating this partnership. We talked about the partnership as being an entity and how the assignment of income doctrine takes a back seat. We talked about what is the taxable year of a partnership. We talked about tax outside. Remember, we know the difference between inside and outside tax basis, right? We talked about how outside tax basis increases if you earn income, decreases if you have losses, decreases if you have distributions. And if the partnership takes a liability, Code Section 752, right? Code Section 752 says your outside basis goes upward, right? And it depends, and you've got to circle this, is it recourse or non-recourse, right? So it's different rules apply if it's recourse versus non-recourse.
Inside basis as well go up liabilities? Inside basis as well?
When you say inside basis, it depends on what's being purchased, but by extension, if you're buying a building using debt, well, whatever you buy using that debt, the basis will equal the cost basis, Code Section 1012. By extension, that's going to increase your outside basis. So I think what you're saying is correct, if you understand what I'm saying, is that assuming you're using those borrowed monies to purchase assets. Okay? Towards the end of Chapter 3, we talked about limitation on losses. I've always said to my classes, you guys know that gains you got to realize and recognize, and losses must be realized, recognized, and allowed. And that with respect to losses, there's several code sections in Code Section 165, 267, and here we're introduced to 3 different code sections: 704D, 465, 469. And even outside of partnership tax, guys, add these code sections to your repertoire of code sections you want to consider with your clients. These are not partnership centric. What I mean by that is they apply, obviously, universally. Notice where they are. They are not under subchapter K, right? Everyone agree? And placement in the code is important, right? Where things are placed. So just bear in mind, yes, we're getting a grasp of what these code sections are in the sphere of partnerships, but your application extends well beyond. All right? So we went through those code sections and their application. Then we turned to Chapter 4, and we said this was a distinguishing chapter, right? Distinguishing. It was distinguishing because it makes partnerships unique. That taxpayers are pretty much at liberty, I should say partners or members are at liberty, to allocate gains and losses any which way they want, as long as they do what, Karen? What do you need? What's the magic that opens the door to anything you want, kind of thing? Say the words again. I want to hear the music. Substantial economic effect, right? Substantial economic effect is what you want. So just make sure you have substantial economic effect. The authors point out that usually that means you got to meet the so-called big three test. In particular, the hardest of the big three is deficit capital account restoration, right? Keep in mind, chapter 4, I've said it before, I'll say it again, largely deals with capital accounts, right? Not with tax basis, but that doesn't mean forget about tax basis. It just means the regulations are geared, right? That people are keeping accurate track. There are capital accounts which represent their economic stake in the entity. And essentially, remember, the code, the treasury regulations say, if you respect the capital accounts, we'll respect them. If you don't respect the capital accounts, we are under no obligation to respect them. All right? So we talked about substantial economic effect. First part, dealing with economic effect, seeing if there's truly economic effect, and then dealing with the issue of substantiality and whether or not one partner is better off due to tax consequences and no other partner is worse off. And we looked at the difference between shifting allocations versus transitory allocations. Shifting in 1 year, transitory in multiple years. Right? And we saw the first half of the chapter, and there's the regular test, substantial economic effect. There's the alternative test that permits something known as a qualified income offset. If you don't meet either of those tests, you have to go to the partner's interest in the partnership. Okay, what is the partner's interest in the partnership? Second part of that chapter dealt with allocations pertaining to non-recourse debt, right? Allocations pertaining to non-recourse debt. And Megan, can these allocations have substantial economic effect?
Yeah. I don't know.
Sure, but you will know for next week, right? Oh, Maria?
No.
It's not.
They can't have some.
Why not?
Because there's no like direct risk going to them. They don't have anything that they can have substantial economic effect on.
All right, I mean, the capital accounts can go negative, but there's no obligation to restore it by its very nature. It's non-recourse, right? And debt does not change your capital accounts. So here you can have allocations, right, that have no substantial economic effect. But what's the quid pro quo for that, Maria? What do you need to have in your agreement? Lisa, what am I thinking? Say it loudly.
Minimum tax charge back?
Have a what?
Minimum tax charge back?
Minimum gain, yeah, minimum gain chargeback.
Minimum gain charge.
Minimum gain chargeback, right? If you're going to get the deduction, at some point you're going to have to pay the piper, right? So that's the quid pro quo. That if you get this deduction, if and when there's a reduction of the non-recourse debt, that reduction of the non-recourse debt will trigger a gain chargeback, right? So if the partnership subsequently walks away from the property, to the extent you've got a non-recourse deductions, to the extent the partnership again walks away from the property, that's a reduction of the non-recourse debt, and that will trigger the minimum gain chargeback. All right, so bear in mind, first half of the chapter talks about being religious. Religious what? Not the religious doctrine, but being religious about keeping your capital accounts in honor. The second half of the chapter is sort of become agnostic. Sorry about the metaphors here, guys. But is that there is no allegiance, right? There is no allegiance to these capital accounts of sorts. I mean, you got to keep the capital accounts because They don't have substantial economic effect, but they become the metric by which we're going to charge back the taxpayers, right? We're going to charge back the taxpayers. All right, so that's the second half of chapter 4. And we went through and spent some time go with that. In chapter 5, now notice the title of chapter 5, guys. Chapter 4, if you don't mind me saying, sort of says, anything goes. When they say anything goes, any allocations go, as long as you have this substantial economic effect, and with respect to non-recourse allocations, at a minimum being charged back. Everyone agree? It's a free-for-all of sorts, okay? There's restrictions, but they're minor, okay, relatively speaking. Everyone agree? And that's what, again, just like subchapter J, dealing with income taxation or trust and estates, has this concept of D&I that differentiates trust and estates from other entities. This is really the demarcation point of what differentiates partnerships from virtually any other business entity, the flexibility. But notice the next chapter, which we're going to be studying tonight, chapter 5, is entitled Ownership Allocations, Income Shifting Safeguards, okay? Safeguards, which means this chapter is dedicated to saying, notwithstanding everything we just told you in the prior chapter, all the flexibility, the sky is not the limit, okay? It might have seemed that way when you read the prior chapter, with an asterisk here or an asterisk there. But this chapter is to remind me, remind our client, that the sky is not the limit. And in particular, you guys may recall from your Lucas v. Earl days and the assignment of income doctrine that you can't simply assign income and losses. I mean, we saw that in Lucas v. Earl, right? Can't assign away income to people who didn't earn it. And you may recall, I'll give you another example from your income tax days, Code Section 1015. What do I mean by that? If, for example, I buy something for $100, a piece of land, and its fair market value is $80, and I gift it to Tamara, right? And Tamara subsequently sells it for $75. Okay, everyone have a visual? I buy land for $100, I gift it to her while it's $80, when the fair market value is $80, and she sells it when it's $75. Tamara, gain or loss to you, and how, if so, how much? And then let us see if you agree. I'm sorry? Are we related? I don't know if it turns, we are or we're not. You tell me how the answer turns on that.
So you give me property, you said it's how much?
I bought it for $100, worth $80, you sell it for $75. Gain or loss, Tamara? Did you say how much?
25.
Say it's a gain of 25?
Yes, you said it's.
I'm selling it for 75. Adela?
I think it's a loss.
You say it's a loss in how much?
I want to say 5 because when you gift it, it's fair market value.
Remember the basis, right? 1015A, Tamara. The basis gets reduced to fair market value in that context. It's not a carryover basis for purposes of determining a loss. So in the hands of the recipient, your basis is 80, not 100, not my basis. And when you sell for 75, Code Section 1001, you may not realize it's 75, the basis is $85,000 loss, right? In other words, solely cannot assign my loss. Remember, that property had an $20 embedded loss. Everyone agree? I could not assign that away to Tamara, right? The code puts the brakes on it. And the assignment of income doctrine looks more at the income side, not the loss side, but I'm just saying there's safeguards vis-a-vis the Supreme Court decision, vis-a-vis these code sections, right? To protect about people gaining losses, right? So similarly, in subchapter K, we have code section 704 C1A, okay, which tries to protect built-in gains and losses. We open up to 704. C1A says income, gain, loss, and deduction with respect to property contributed to a partnership by a partner shall be shared among the partners so as to take account the variation between the basis of the property to the partnership and its fair market value at the time of contribution. Everybody see that? So that memorial codifies this notion in the sphere of partnerships. And the authors, and for exam purposes, we're going to look at issues pertaining to the sale or disposition of contributed property and the depreciation, those two things. So we talked about built-in gains, built-in losses, and how to handle. Page 157 begins a discussion of sales and exchanges. Notice, we're going to talk about depreciation, we're going to talk about sales and exchanges. And the sales and exchanges, you can handle it in one of three methods, right? The so-called traditional method. We'll go through several examples of this today. And remember, we're trying to give the non-contributing partner, what they bargained for. Non-contributing partner. The traditional method typically may engender what's called the ceiling rule. The ceiling rule is when the non-contributing partner doesn't get what they bargained for. You're up against the ceiling. The traditional method doesn't address that or address it adequately. So the regulations permit two other approaches. One is called the traditional method with curative allocations, which permits you to use other income that the partnership has, as long as it's of the same nature, to produce or yield the same outcome. And this so-called remedial method. The remedial method, which allows you, when it comes to sales, to just fill in the blanks, essentially. Okay? So you can produce the same, or what I'll call the right outcome. Okay? And we'll go through some examples of this. We talked on page 162 about code section 724 that preserves the character of these assets, preserves the character of contributed assets. Okay, that pertains to accounts receivable, inventory, and capital loss property. Notice we changed, beginning on page 163, we talked about depreciation of contributed property. And we, not surprisingly, talked the three methods, right? Traditional method with curative allocations, and we'll see, a little bit challenging is the remedial method, okay? When it comes to depreciation, you actually have to go through an exercise where we artificially create two assets, an existing asset and a new asset out of thin air, and go through that. So just be forewarned that the remedial method, when it comes to depreciation, is a little bit more challenging than some of the other things that we've seen. On page 167, the authors talk about, I'll call it the reverse of contributed property, when you have a new partner who enters and there's appreciation in property or the property has an embedded loss, how you're supposed to handle that situation. So the regulations address that again. If there is an existing partnership and someone new comes along, some of the same concepts apply as if there's contributed property there. I told you, don't worry on page 168 about the one paragraph that goes from 168 to 169. We'll talk about distributions of contributed property soon enough. And there is an anti-abuse rule pertaining to lost property, which is never a surprise, right? Congress is always circumspect when it comes to those issues. On page 170, we looked at, I believe we looked at problem 1, and we had begun the discussion on problem 2. Before I continue, any questions, issues, concerns? Anything gnawing at people? Go ahead.
Task was for the midterm, like if we were answering a question, we could expect us to say justifying the authority as a this because code section.
I don't know if you'll need a particular, the exam is open book, open note. I'm probably just gonna look for the numerically correct answer in the character, all right? Andrew?
Can you just, how is the test gonna be made up, like all multiple choice or?
No, it's gonna be a combination, true, false, multiple choice, and a short answer. Okay. Other questions? I'll be around this whole week, so if you get stuck or having a sleepless night and you talk to one of your colleagues and 2 or 3 or 4 of you can't figure it out, or you're going solo, just shoot me an email. Just make sure the subject line puts partnership tax student or something that I'll know who you are. And if I don't get back to you soon, don't be bashful. I'm not affronted. Somehow I missed your email. Just send it back. High importance. And if I don't get it, everyone knows my phone number, 353-1727. I'll repeat, 353-1727. I check my voicemail regularly too, so that too, don't be bashful. Busto, you have a question?
Yeah, I was gonna say, like, which chapters should...
Everything goes. Chapter 1 less so, but everything else goes. How's that?
How long is the test?
Probably 2.5 hours.
Were you teaching before?
No.
I don't want you to, but I'm just asking.
I may be. Well, now that you say that, yeah, I am. Was there a reason?
Oh, no, I'm just asking.
Okay.
Teaching us stuff or teaching?
Oh, no, you mean teaching before the,
Yeah, I'm sorry, the
Yeah,
half
how long did
hour. that
No.
was an hour.
I tried that once and people wanted to kill me. So, I did try that and people, I tried to teach after the exam and people thought I lost my mind. So, I gave up on my half an hour. Right? Anyone do anything interesting this weekend? Aside from studying partnership tax? I did take a journey, and I'll recommend it. Some of you may have heard this from my Monday night class. What is the tallest waterfall second tallest waterfall east of the Mississippi? Where is it located?
Bushkill?
Where was that?
Bushkill?
Bushkill? No, second tallest waterfall in the Garden State. No.
Upton Lakes.
No? There, I think I heard it.
Patterson?
Yep, Patterson. Patterson has, believe it or not, the second highest waterfall. It's literally 1 minute off Route 80. You guys have passed it 100 times, never knew it. And I didn't know that Patterson was the home of the engines. There's some of the largest mills in the country in the late 1700s because to power this waterfall. Washington, Alexander Hamilton, they all had lunch apparently at the top of the falls, so you can relive a little history by having lunch at the top of the falls. And there's all these mills right there because again, Patterson powerhouse powered all these. And famous poet Ginsberg Also, Louis Costello, Patterson, and William Brennan, the author of Duperstein decision, all from Patterson. So it had a really neat museum. So if you get a chance, the New York Times did a whole write-up saying everyone must visit Patterson. It also has one of the most ethnically diverse communities in the entire country, too. So from Lebanese, what was Alicia?
In the entire country?
Yes. Look at, go Google Patterson, New York Times, read the article about the diversity of its population. It's pretty incredible. All right, so, but aside from that, again, if you want to see a pretty neat waterfall and you don't want to go up to Niagara Falls, there you go. Right off Route 80, I'm telling you,
It's called
30
Patterson
seconds.
Falls? Was it?
I don't know what it's called, but I guess it's called Patterson Falls.
Now you don't have to climb to have the lunch up there.
You do not have to climb. You are at the top. Just don't try to get such a, don't go for the selfie right by the edge, guys, all right? Because I don't want to read about it, all right? All right, you guys ready? New stop? Let's do it. All right, so let's do question 2. This is an important question in exam. You know, when you ask Jonathan, it could be a question like this, right? This would be fair game. You wouldn't get mad at me because you've seen it before, right? You might get mad, but hopefully not at me. All right. A contributes $100,000 cash, okay? And to the AB partnership, B contributes a building with an adjusted basis of 50, fair market value of 100, unless otherwise stated, apply the traditional method. Okay? We may have begun or done some of this, but I don't mind repeating it just in case I lost people. All right? So, you know, guys, partnership tax builds on itself, right? You got to know the basics. This is a 721 transaction, and we have inside basis and outside basis. Okay, and so if you just want to run through the numbers here, Amar, what am I going to just give you the 4 numbers across the top, and Busto, see if you agree with Amar.
All right, so A has the tax, $100,000 tax,
I'm just going to write it out, and Busto, you see if you agree.
and same as book, $100,000 for book value. And B has the 50K tax and 100K for book.
Okay? Busto, agree?
I agree.
Okay, and I believe we had to do the second part of the question now. We've established that if the building is depreciable, has a 10-year remaining recovery period, it's depreciated under straight line, and we're keeping it real simple here. So, and I would tell you this for exam purposes, okay? Just don't, you may fear other things, but you're not going to have to compute this depreciation deduction. I will give you that. Benny, I will give you that number, okay? Do not worry. All right. So, having said that, Louis and Hira, see, what are we going to take for depreciation purposes?
For the tax purposes, you're gonna take 5,000. There'll be the depreciation.
To whom?
5,000.
Hira, you want to try
A.
it? Okay. Keep telling me what numbers.
And then
right.
book depreciation rate would be 5,000. And then B gets book depreciation of 5,000.
Let's start with depreciation here. For tax purposes, some book purposes, we have tax purposes 50 divided by 10 is 5,000 per year, and 100, right, divided by 10. Economically, they're each going to get 10,000, right? That's the book depreciation versus tax depreciation, right? Keeping it very simple here. And remember, what did these partners bargain for economically? They're going to split things 50-50, agreed? And that's why we're subtracting 5 and 5, right? Because economically, their capital accounts matter. Got that, John? All right? But the non-contributing partner, namely A, wants to get his fair share or her fair share of the deduction. Everyone agree? The non-contributing partner. What's gonna happen, guys, after 10 years? What do you think? What's those numbers gonna look like? All gonna go down to 50. Right? Everyone agree? Everyone can handle that for exam purposes. And the next question. We asked fees basis instead is $60. Benny, Amber, Benny, what do you want to read it from left to right? What the number should be in your opinion?
5,000.
I'm just going to write. Keep going.
5,000. No, oh, you mean the.
Yeah, let's start.
100,000, sorry.
All right. So we're going to just replicate what we had before.
100, and then 60, 100.
Okay, so talk to me and then Amber, chime in if you think you would do it differently. Go ahead.
The depreciation?
The book depreciation is 5 for each.
Okay.
And then the tax depreciation to the non-essential.
It's 5 and 1 together.
Right, because in this case, take the 60 divided by 10 is 6, and book is going to remain at 10. Everyone agree?
Question though.
Go ahead, Benny.
Since his intention is to recoup the 5 from, I mean, the difference in the 50 and 100, why did they split the balance of the 1,000? Like the team getting 55?
Well, A got his fair share.
He did,
A got what A deserved.
correct.
So why should he get more? By the way, let me, before I forget too, I think hopefully all of you got an invitation to a brunch November 5th. Did anyone not get it? Diane, are you on the listserv or
I thought so. Maybe not.
was that yes or no?
I'll check.
You'll check? Did most of you get it then? Who got it? Can I see you show of hands? All right, so if I can do a little plug here, November 5th is a Sunday. What better way to start a Sunday morning than with a little tax, right? And we have this superstar guest speaker who's going to be talking about communication. I will be in the front row. I want to hear about how to communicate better. So if you can and have the opportunity to come for brunch, I hope you consider joining us. It should be fun, all kidding aside.
This is the alumni event? for
Yeah.
$30.
You're not alumni, but you will be. So why not, fast forward. Yes, Michelle.
$30?
I'm sorry?
$30?
Yes, $30. It's a bargain because you get continuing education credit, breakfast, and entertainment. All packaged as one. Adrian, you think you might go?
Yeah.
Is it a yes or no?
No.
Can't go?
No.
You're busy?
Yeah.
All right. Next time. Next time. All right.
Question?
Yes.
What's the value of continuing education credit?
You need it for your license.
Okay.
You have a license.
It's in here, may tell you, it's fairly cheap. I don't know what credits cost, but I know when I get credits, the credits can run easily $100 a credit. So this comes pretty cheaply. Andrew?
Can we just dive into a little how we get to the 5 and 1? I know there's 6 total for tax.
Right.
And is it 4 and then one to each?
No, I don't know where you get the word for or why for. In other words, the non-contributing partner
Yeah.
should get what he bargained for. In other words, had he gotten a building, remember, if he bought a building worth 50 with a basis of 50, he would have gotten all $5 worth of depreciation, right? I mean, in theory, when B comes to the table, B should be bringing $100,000 cash too, and had B brought $100,000 of cash, everyone agree? It would have bought a building for $100,000, and there would have been book depreciation of 10 and tax depreciation of 10.
Okay.
All right?
Yep.
So the non-contributing partner should get what?
What would have been?
Yeah.
Okay.
Thank you.
Is there a specific regulation that explains this, or?
I mean, the regulations the author cite you to, Megan, are pretty on point. I mean, they don't hold back, and then the examples are exactly this. Like I said, the authors are not creative, are they? If you read the examples the authors cite you to, Megan, they follow this to a T.
I was asking if you knew the specific ones, but.
If you want, I'll give you a site. I mean, these are 704-3B1. 704-3B1. It's a good starting point. Okay?
Would it be safe to say that the tax deduction cannot exceed the book deduction? Like that's why the 5?
No. We'll see. Tax deduction can exceed. We're going to see an example of that. All right? Amber, you were going to say?
No, it's just, the non-contributing partners share is just limited to the book. That's an easy.
Yeah, the non-contributing partner is limited to the book.
It's just, it's that way.
Okay, everyone's going to have their own possible way of conceptualizing this, but hopefully you get everyone, whatever your conceptualization, you get to the right answer. All right? Question C, let's change it up. This time, B's basis is $40. So, Jesse or Yolanda, do you want to just tell us what you would do here?
So 100 for A and T and B.
And what would I do with B?
40 for T and
40, yeah.
Yes. And 100.
Okay, and we'll do the same exercise of 40 divided by 10 equals 4, and 100 divided by 10 equals 100. I mean 10, sorry. So Yolanda, or how much depreciation would A get?
And 4 tax. And 5 for book. And then for B, 0 and 5.
All right. And this is a manifestation of what rule, guys? The ceiling rule, right? Everyone agree? Because A deserves, right, $5 worth of depreciation, but A is bumping against that ceiling, right? We know in problem B, they're all going to get to 50, right? Ultimately, over the 10-year time period. Everyone agree? In C, that isn't true. All right? So this is clearly, now what the authors point out is down the road, when and if the partnership is liquidated, that ultimately C will get the benefit of having the higher basis, but it could be years in the making, okay? Even though economically, in theory, her value has gone down by 5. So C is not a happy camper here, right? Excuse me, taxpayer A. is not a happy camper under these circumstances. Go ahead.
So for question C, for B, for tax purposes, B will not take any deduction for the coming 10 years.
Fine. In question B,
For
we'll
question C,
take 1,000. Question C, no depreciation deduction
for 10 years.
for 10 years. But our heart doesn't bleed because, in fairness, he brought to the table this contributed asset, which has a very low tax basis, right? All right. Let's move on to D.
Does the partnership have to do anything to?
This is
correct it?
required. In other words, prior to chapter, we had
So,
flexibility.
do they have to do anything to correct that imbalance for A, or?
There is no correct, there's no,
They don't
it's
have
not,
to take the curative or anything
they
like
did not have to take curative measures.
Okay, so that's
Right.
not required then, they can choose.
Not
to do
required.
so. Okay.
The authors point out that maybe it should be required, but there is no, right now, it's not required.
Okay, thank you.
Okay. Question D. Now it's 120,000 is the basis here. So, Eman, Lisa, let me give this to you. So, what's the numbers that I go through here?
So, 100, 3, 100,
Yep.
120, 100.
And then we're going to do the depreciation for tax and book purposes, right?
120 divided by 10.
120 divided by 10 equals 12,000 in depreciation. And for book purposes, 100 divided by 10 equals 10. Okay? So for those, I apologize. On this corner, probably can't read, but can't move this board. But it's just me showing 120 divided by 10 equals 12. 100 divided by 10 equals 10. Okay? Eman or Lisa?
With depreciation for A, tax purpose is going to be -5, -5, -7, -5.
Lisa, agree or disagree? Everyone agree that now the converse is happening, right? Taxpayer B is bringing to the table something that has robust basis, right? And who should get the advantage of that? That advantage should not inure to taxpayer A, right? So that advantage is going to inure to taxpayer B. Question E. Same as it, except the building is sold for $90,000 after it is held and depreciated by the partnership for 2 years. How much does the partnership allocate the tax of the gain? So everyone take a minute, pretend it's an exam, and come up with an answer. So take 2 years of depreciation, guys. Kelly, Raphael, Dawn, guys, have some numbers.
Well, would you take,
Just say it loudly, Dawn.
would it be $50,000 gain?
Say again?
Would it be a $50,000 gain? Or
For
would
what
it be-
purpose? Now remember, you gotta do it for tax and book. Everyone agree?
Okay, so book, there wouldn't be,
What's the total tax depreciation we've taken?
10,000.
Everyone agree, 10,000, right? 2 years, 10,000. What's our adjusted basis in the property for tax purposes?
40.
Everyone agree? 40. Everyone agree? So we have 50 minus 10, our adjusted tax basis. This is code section 216, or adjusted tax basis But section 1011 is 40, right? For book purposes, what is it?
20.
So it's 100 less 20. It's 80. Okay, everyone agree? That's the book basis. How much are we selling it for? 90. So is there any gain or loss?
Yes.
Gain of how much? 10 per book, right?
Yeah.
90 minus 80 equals $10 gain per book. What about tax purposes? 50, right? 90 minus 40, right? This is code section 1001. It's $50 gain, right? So $10 for book purposes, 50 for tax purposes. Agreed? Yep. Okay. We're on a roll. We got that done. Now, what are our capital accounts? Raphael, Kelly, what are they now? After 2 years. I'm sorry, is that for everyone or just?
For the book values, 90, and me.
Okay, so this would be minus 10, so that would reduce it to 90, right? Right, because it's over 2 years. Right? Keep going.
And then tax value, 90 for A, and 50 still for B.
Right. This is minus 10. So it's 90, 90, 50, 90. Everyone see that? What we did is take 2 years worth of depreciation, right? We just doubled things. All right?
You have to allocate the gain. So
Okay, hold on. Let's just get this far, right? So we have book gain, we have tax gain. And we have we're maintaining our capital accounts and tax basis, right? All right, so now we just have to bring it home, right? Raphael, how would you allocate this? You're not sure? Ashley, you were going to say?
for book purposes, I would split the 10 gain.
Okay, economically, these are 50-50 partners. Everyone agree?
Yes.
So they each get 5 of the gain, right? Keep going. What are we going to do with the $50 of tax gain? Right, Luke.
All goes to B.
Luke says what? Allocate all 50 to B?
Yeah.
And would you agree, Ashley?
Yes, because the embedded gain goes to the contributed.
So you allocate it all to B. And Eric's saying no. What would you do, Eric?
First 40 to B.
The first what?
40 gets out.
Why do you say the first 40? Where'd you come up with that number?
The amount realized.
Don't, guys, what's our mantra here? Give the non-contributing partner what he deserves, right? What does A deserve here in terms of 5? He has $5 worth of gain, right? Isn't that what Kelly allocated him? Or?
Yeah.
Let's give A 5. That's what the non-contributing partner had in terms of income. Everyone agree?
Yep.
Why should he be taxed on more? Why should he be taxed on less? Everyone agree? Economically, he had an accretion to wealth of 5. Where does this leave us? What should be taxed on? 45. And feels good because what do we have?
95 across.
95 across the board. Eric.
I just want to make sure maybe my logic path is different.
Just say it loudly.
I was going with the amount realized was 90, so that's 40,000 in excess of B's basis, and then the rest is split evenly.
you know what, you can say, and I don't mean this badly, I don't know how your brain was thinking, but I just know, and call me a simpleton, I just know we gotta give the non-contributing partner what they got economically. So, any other thing you say is not gonna register with you, if you don't mind me saying. All right, so if we can keep it that way, guys, give the non-contributing partner what he or she or it deserves, and everything else goes to the contributing partner. Let the chips fall where they may.
Excuse me.
Benny,
One of the position deduction advantage that he got, I mean, the 10,000 so far, that's what he got in 2 years.
be careful about the word he. Who is he?
A, the non-contributing partner. He
Yeah,
did
he
get
got 10.
5,000 tax deduction for the 2 years.
Right?
While he got nothing. Doesn't he get to recapture that?
I'm not sure. We didn't talk about character of the income. Okay? This is 1250 recapture income, maybe. I did look at the nature of the building, but does it?
So what can I say? Because it adds up to 10,000 anyway, they had to recapture, so can that?
When you say that, he got these deductions, and then when the building is sold, he had an economic gain of 5, he should be taxed on 5. Then I mean, we're not taxing him more or less than what he got.
In the 2 years, he got an economic gain of 10, so the 2 years.
I don't know, you keep saying he has a gain of 10, but you don't, you gotta show me where he has a gain of 10.
Well, not gain, but the depreciation deduction that he was allowed for the 2 years.
He was allowed depreciation deductions, I agree, of 10.
Okay.
But now he's only got, at the end of the day, let me just point out to you that what's going to be is that he got depreciation deductions of 10. When this property is sold, let's just think about this.
Imagine A's basis in the building starts at 50, and B's basis in the building starts at 0. And then you picture A's basis in the building starting at 50, and B's basis in the building starting at 0, and then you split your proceeds. So A got $10,000 of tax depreciation, lowers it to 40, gets $45,000 of proceeds. That's where your $5,000 for A, the economic actual gain.
Yeah, but they have a placement development.
I'm going to tell you one thing that can I make an observation? Sure. How much money is in the bank account when after this property is sold, guys? 190. Everyone agree? If the partnership were liquidated tomorrow, remember, he got $10,000 of depreciation deductions, right? He started off with a basis of 100. His basis is now 90, and he's going to get 95. He's taxed on 5. Does that prove my point, Benny? Do you follow the numbers? I mean, literally the guy is going to get, taxpayer A, $95. He contributed 100, he took $10,000 of depreciation, he should be taxed on 5. You're not going to be able to convince me to the contrary. It's not a sleight of hand on my part. Seriously, Mohammed?
No, I was just going to say, I think she meant A got the benefit of taking a depreciation deduction, so why wouldn't he be allocated that back as a gain? Yeah, but I see why.
You see why? I mean, he had an economic gain of 5, we tagged him with 5.
So right now, we're assuming.
But by the way, can I make, if you think about these things, you can check yourself. If there's an illogical answer, you better go, check where things went right or wrong. Diana?
So we're only doing 5. We're assuming it has a basis of 95. It's being sold in year 2, so he's really not going to get the 5,000.
No, we're told to take 2 years of depreciation, Diana. It says. In the problem itself, it says take 2 years of depreciation. And presumably it's sold in year 3. Just go with that, Diana. Okay? Other questions? Amen?
So to check my calculation, when we sell the building, whatever.
Who sells the building?
Partnership.
Right.
So tax purposes and both purposes, everything has to be equal. See, I see the 95 across the board for.
Right, I mean, remember, Code Section 704C1A is designed to stuff B with the consequences of this contributed property. Yes?
So I need to check myself. All the 4 lines need to be equal to the same number.
I think that will often be the case. I don't want to say that categorically, you know. I got to think about that. I don't know if I will say it will always be. Okay? I understand why you want to draw that. I
You want to plug the number.
I know you want to plug the number. That's what I'm afraid of. So I don't want to say yes and then you blame me on that one. All right? But my mantra, Eric, again, give the non-contributing partner what they're entitled to. Everything else goes back to the contributing partner, okay? That's what the regulations say. Question F. I'm not going to say a word. We're going to sell the building for $60,000, okay? Everyone come up with a computation. All right? Andrew, Javier, what do you guys have here? Gain or loss here?
For book purposes, a loss of 20, so 10 and 10.
Book purposes, right, is a loss of 20. Everyone agree? We only got 60, so that produces a loss of 20. For tax purposes?
I want to say 10 for A, and then...
Hold on. Let's just look at overall. Is there a gain or loss? Right, the amount realized is 60, the adjusted basis is 40, right? The gain here is 20. Everyone agree? Everyone agree, for tax purposes, Code Section 1001, the property is sold for 60, the property has an adjusted basis of 40, right? So there's a gain of 20,000, and for book purposes, there's a $20,000 loss, right? Okay. And we have Kelly had indicated the capital accounts at the time, well, tax and capital accounts, $90 basis, $90 capital account, $50 tax basis, $90 book account. So how are we going to allocate the book loss? 50-50, right? Because we're 50-50 partners, right, bro?
Please don't ever do that again.
Sorry. All right, we're there. Okay, so what are we going to do with tax? What do you think we're going to do, guys?
It doesn't get squat.
50-50.
All B.
I would put 30 to A, sorry, to B and minus
30 to
loss.
B and then a $10,000 loss.
I hear lots of different numbers here.
Purely traditional method?
We're pure here. Uh-oh, Louis, what happens in that case?
Not what I had on my paper.
Pure method, Louis. What are you going to do now that you have an eraser? Who should get saddled with the 20,000 a gain? No choice. B. Does A get saddled with anything? No. E-man, you're not going to be a happy camper. 90, 80, 70, 80. Not going to be pretty. This is the ceiling rule, right? We can't give the non-contributing partner a $10,000 loss, right? Everyone agree? There isn't a loss to be had. To the contrary, there's only a gain. Now, if this property had originally been brought in, you know, at its fair market value basis, consequences would have been wholly different, but that's not what was because of the nature of the contributed property. That's the only reason. Here is a property that's declined in value, and there's still a tax gain on it. Whose fault is that? B. There's all sorts of things. The two other methods can address this. The traditional method with curative allocation and the remedial method, but For the moment, we're not addressing it. This is the answer under the traditional method, okay? If A has no tax consequences, book loss of 10, B gets settled with the 20,000 of gain, B gets the 10,000 of loss, okay? All right, so if you're having fun with all this, which who would it be? Question F. Any questions? But G. Andrew, you got a question?
Yeah. Can you choose, so the remedial method is used to equal the partner's accounts, the capital, the balances at the end?
Yeah.
Can you choose to do the remedial method 1 year and then next year not do it?
Not for depreciation purposes, but for gain purposes, you can.
Okay.
Okay? Gain and loss purposes.
So is E the remedial method?
This is traditional method right now.
But for problem E, is that remedial?
We didn't do any remedial method yet. That was just the regular method. There's no need for any, we didn't have to take corrective measures there.
Because the ceiling rule didn't kick in.
The ceiling rule did not apply. All right? Question G. We're going to go back to problem C above. If the recovery period is 20 years, hey, remember, there's 10 years remaining on the property. Everyone agree? There's 10 years remaining on the property. And the actual recovery period, if it was new property, would have been 20 years. And we're going to use the remedial method. So take 2 minutes and try to do this computation, guys. Okay, let's think about this. For tax depreciation purposes, how much depreciation is left in this building?
10 years on.
It's 10 years, right? So for tax purposes, 10 years, and the building has an adjusted basis of 40, and we're told, right, that it's got 10 years. Adjusted basis of 40, 10 years, Code Section 168, a simplified version of Code Section 168. We're ignoring mid-month convention, we're ignoring all these things. We're keeping it real simple. Yeah, but in other words, we just put into service, right, into this partnership, property with an adjusted basis of 40 that has 10 more years to run. Admittedly, it's 20-year property, right? But that doesn't matter, meaning for the moment. In other words, if this person just continued depreciating this property, right, taxpayer B, right, it would just continue to take $4,000 of depreciation a year. Everyone agree?
Are you gonna make it this confusing on the exam? 10-year thing?
Well,
Yeah, we thought it was 20 years, so.
Right, but
Where does it put into play that there's only 10 years left?
it says right in the beginning of the problem. Problem A, right? 10-year remain. Do you see that in problem A, Ashley?
So the remainder of the 20
All right. Ashley, you seem so disappointed, but all right. Well, we'll try to mellow you out here. All right. So we got 10 years remaining, so we know the actual depreciation is $4,000 a year. Agreed?
Yes.
All right. Now, we also know, and keep in mind under the remedial method, and I know maybe you're itchy for a site. This is again under 704-3D2 this time. 704-3D2. And just so you know, there's an example directly on point here. 704-3D7, example 1, 3 little i's. I'll repeat. 704-3D7, example 1, 3 little i's. Okay? Now, let's talk about this. The regulations say, consider as if you have 2 assets. The first asset has a tax basis equal to whatever the then fair market value is. excuse me, let me rephrase that. The tax basis, how do I frame this? The tax basis is the same as the asset, is the same as the basis of the property. Okay, let me say that. That the tax basis of, I'll call it asset 1, is equal to whatever the tax basis is. Asset 2 will have a 0 tax basis, so to speak. In other words, it's the amount in excess of the adjusted basis up to the fair market value. So how much is the fair market value of this building? 60, right? So that's treated as the set, everyone agree? The value of the building is 100,000. The adjusted basis is 40. So we're treated as having one asset equal to the adjusted basis equal to 40. Everything else above, in this case 60, is considered a second asset. And notice the denominator here, Ashley, you'll like this, is 20, not 10. You treat it as a second asset as if you're putting that new property into service over the say again, Dale?
The full life.
The whole life, whatever, if it were a new property, and that would be $3 or 30,000, or whatever, add as many zeros as you want. All right, so first property is considered equal to the basis, and you take it over the remaining span. The second property is considered new property, and it has a different denominator.
That first piece, is it always going to be the same as tax basis?
It's supposed to be.
It's supposed to be, right? Okay.
Yeah.
Okay. Trying to think
So,
it's not, but okay.
What is, in this case, what is the total depreciation?
Total depreciation is 7 per year for the
$7,000.
for the
Okay.
first 10 years.
Is that book or tax?
It is for book purposes. It's considered the combination of, hey, look, we have two different pieces of property, right? One worth 40, one worth 60. It's $100,000, right? So for book purposes, we are going to get $7,000 in depreciation. Everyone agree? And we know what the tax depreciation is. So this is book depreciation. We know what the tax depreciation is. That's a given. That's a tax concept found in Code Section 168. How are we going to split the book depreciation, guys?
50-50.
50-50. Heck, we're 50-50 partners. We each get 50-50. And let me, I apologize. I should first put down the numbers that they're entitled to. So we start off, as you know, with 100, 100, 40, 100. And then, how are they going to split the book depreciation?
35, 35.
35 each.
Wow. 3.5, I guess.
How much depreciation does A get? And then I should.
3.5.
Are you a different number? A is the non-contributing partner. How much does A deserve? A says, damn it, give me the 3.5. I deserve it, right? He's the non-contributing partner, right? For tax purposes, right? So A gets it. How much tax depreciation does B get? Whatever is left, which is 0.5, right? Because there's only a total of 4,000 to divvy up, right? A's got 3,500. B's going to get 0.5, right? Let me pause there. Does everyone see this? You're creating two different assets. One for book, under the regulations, under the remedial method, you got to go through this step. You're trying to create an asset worth $100,000, comprised of two different components. An old component depreciable over the old lifespan, and a new component depreciable over its whatever the useful life of that property is. Ellie,
So the purpose of this is so he can take depreciation.
who can? No, it's to make A whole. Remember, A is the we want to make A, the non-contributing partner, get what he deserves or she deserves, right? That's the purpose.
Yeah, because otherwise A is stuck on taking 4.
Otherwise, A is only going to get stuck, right? With 4,000, the ceiling rule is going to apply. So, picture, if you will, and maybe by getting to the end, it will make it easier to see what's going on in the middle. What's going to happen over the next 10 years, guys?
Same thing.
Same thing. History, Groundhog Day, right? We're going to have the same thing happen 10 years in a row. So you can just take out your decimal place, right? Take out the decimal point, and you're going to reduce this, right, for the first 10 years down to 65. Everybody agree? 65. You're going to reduce this down to 35. You're going to reduce this down to 65, right? Everyone agree? So just years 1 through 10. Amber, you got that? Okay. Now, what's going to happen in the next 10 years?
Book depreciation is only going to be
3,000.
How much is book depreciation going to be?
3,000.
3. Everyone agree? Book depreciation is going to be 3. How are they going to allocate that? Book depreciation. 1.5 each, right? All right, we have the second asset for the second 10 years. Who's going to get tax depreciation here, Kelly? No one?
The second 10 years?
During the second 10 years, this is a remedial method. E-Man's going to love this. What are you going to love, E-Man?
Plugging the number.
Plug in the number.
A's got to get it.
A's got to get it. I like the way Dill thinks. A's got to get it. We're going to just create this number out of thin air. And so A's going to get his fair deduction. But we got symmetry under the code, right? We can't just give A deduction. We got to settle B with income of 1.5. And that's the magic of the remedial method. We'll just take the number out of thin air, literally. But we got to take whatever we do here, negative, we got to do positive on the other side, right? And guess what's going to happen after 10 years? E-Man. E-Man?
Net is 0.
After 10 years, is it going to net to 0? 50, 50, 50, 50, straight up. So Kelly, these are just a product of our imagination of sorts, right? Those are just plug-in numbers, right?
The traditional though, A got more deduction, even though.
No, ultimately, A's going to get 50 under the ceiling method. A only got 40, right?
They're not planning on holding the asset that long.
Don't mentally, let's not go there. Let's assume they hold the asset, but the problem with the traditional method, after the 10 years, they only got $40 worth of depreciation deductions, right? Never got the full $50 worth of loss, right? So here, there's a remedial corrective measure taken so that A can get the full benefit of the $50 write-off, right? Don't confuse yourself talking about a sale. I don't think that's productive.
Question. So just to be clear, the second to last line is year 11, and the last line is the year 20, right?
Yeah, I should, by the way, I apologize. Yeah,
Yes.
This is year 1 through 10. This is year 11 through 20.
But we should have, I mean, positive 1.5 was right, or?
Oh, I apologize. Yeah, I should.
And the 0.5 up top should be the negative.
Yes. I knew I should have parentheses somewhere, and I just missed my parentheses. Yes. All right, Andrew, did I answer your question?
Yeah,
Jesse, you got
the
this?
second to last row is year 11, and the last one's year 20, yes, or after 20.
Yeah, well, this is after 20 years, yeah. Ashley, you got that?
I think so. Find out.
All right. Again, the authors go through an example in your textbook, just so you know. Page 166. All right, but again, are the authors creative? Are the authors original? No, no, no. It's all from the regulations, okay? Diana?
So for B, why does this tax basis start to increase?
Say again, in B,
For B,
why what?
why does this tax basis start to increase, unlike the other ones?
Why does this tax basis what?
Start to increase by 1.5 instead of decreasing by.
It increases by 1.5.
Yeah.
Because we need to, this is artificial, right? There's no more tax depreciation. This asset's basis is truly 0, right? Everyone agree? By year 10, this building has no tax basis, right, Diana? So this depreciation is just pulled out of thin air, right?
So it's like a capital gains magic wand for doing previous profits, just in the second half of the year, essentially.
Maybe a way to think of it. I got to think about that. Diana, do you see that? I mean, these are totally fictitious, but that's the remedial method. It's fictitious.
So the partnership elect the remedial methods, right?
Yes, I mean, it's got to elect this method.
And will benefit partner B.
How will it benefit partner B? B's not a happy camper. B's going to have to pick up income.
At the beginning, it will, for the first
Yeah,
years,
he'll benefit a little bit.
so
Yeah.
it will work in B favor.
For the first 10 years, for the second 10 years, he's get payback time.
And to make up.
Okay?
I think that was the reason for election of this message, is to get this B.
You got to be careful. I mean, sometimes it works out well, sometimes it doesn't.
So what is the purpose of it?
I mean, the purpose is to make A whole, because A wants to get a full, $50,000 worth of deductions.
He will anyway under the traditional method.
No, he wouldn't, because the basis here is 40. So under the traditional method, he would have only gotten 40. Now he's getting 50. Think about that. Look at it again at the answer to problem C. Partnership tax is, fun once, but twice priceless, right? All right. Let's talk about question 3. We have, again, guys, keep in mind the context, because context is important. If you don't see the bigger picture, you can't see the minutia. And the bigger picture from 30,000 feet up truly is, and comparisons are important, and they're effective in linguistically, but they're effective here. The authors want to purposely share with you the general rule in the prior chapter about the flexibility, but by juxtapositioning the flexibility in chapter 4 with the limitations in chapter 5, it hopefully will stick with you. The limitations, bearing in mind, from 30,000 feet up, you got Lucas v. Earl, you got Code Section 1015A, and the notion that you can't the contributing partner is saddled with the consequences, right, associated with the property they bring to the table. He or she, I should use a pronoun, singular pronoun. The contributing partner is saddled with the tax consequences he, she, or it brings to the table. Everyone agree? And that's what these charts are all about, right? That's the big picture. The non-contributing partner, by way of contrast, shouldn't have to live with the consequences, right, of what the contributing partner brings. And that's why the capital account, right, the tax consequences try to follow the capital account to the non-contributing partner, right? So that's the big picture. Now it's up to you to take that big picture and apply it on a case-by-case basis. Right, guys? That's your objective. Let me mention to you, people who've had exams, if you could, there's one of me, and there's lots more of you. So for exam purposes, guys, you really got to use, sorry, this sounds like we're going back to kindergarten, but it is what it is. Use the restroom beforehand. I can't have people coming and going, okay? And if I can last 2.5 hours, everyone else here can. And, big coffee drinker that I am, you guys just, control your intake if that's going to be a problem, all right? But I really can't have people, if you have a medical issue or problem, shoot me an email and we'll talk about it. But if you can, come prepared. Nothing electronic, okay? Bring a simple calculator. The computations themselves are going to be simple, but if you feel more comfortable, you can bring a simple calculator, but not a cell phone, okay? I repeat, not a cell phone. No one is to have a cell phone on the table. Nothing along those lines. Amber?
Did you say no scientific calculator?
You can bring a scientific. I just meant nothing fancy, like a cell phone. No Apple 10s, okay? Other questions? And again, I will be around all week. So, you're lost, you're bewildered, you got to reach out to me, okay? And consider, if you haven't, getting Federal Express to you some of the supplementary textbooks from Cunningham to the Black Letter series. Both of those books have questions. So once you think you really know our textbook, test yourself and see if you really know our textbook, okay? By using other people's questions, okay, that are available out there. All right, question 3. A and B, dealers in real estate. Find a parcel of land, so they're dealers. What is real estate in their hands, guys? Inventory, thank you. Find a parcel of land to purchase for $100,000 as an investment. They believe it could be sold in 2 years for $100,000. Good for them. They either will buy the land as tenants in common for $100,000 and jointly contribute it, or contribute $50,000 each to an equal partnership, which will then buy the land. You guys are their tax counsel, okay? What are you going to tell them to do? Wait, 10. Are you going to tell them to contribute buy the property, contribute it? Or are you going to tell them to contribute the cash and have the partnership buy the property? You got to say it loudly. Not sure? Mariana? What would you advise? What code section are the authors telling you to be aware of? Andrew?
Yeah, I don't know the code section.
Well, what are they, Oceana, what are they trying to brace you for? 724, right? Now you got to be careful because property carries with it taint, right? For 5 years, right? You contribute inventory, the taint stays with it, right? For 5 years. So, is it better to contribute the property or is it better to contribute cash? Cash, right? Everyone agree? Contribute the cash, let the partnership purchase it. In the hands of the partnership, if it's an investment, it keeps its asset, right? As a capital asset under Code Section 1221. So the answer to A is that you would deserve your pay for that day if you told your clients, do not buy the property first and then contribute it. contribute the cash and let the partnership acquire the property. All right, everyone got that? That was the easy one. Question B. Assume that the partnership purchased land for $100,000 in year 1, appreciated to $200,000 by the beginning of year 3. At that point, C wants to join, right? It's an equal partnership by contributing $100,000 cash to be used by the partnership to improve the land and sell it. Now, just so you know, because you can miss this, and I actually underlined it. Notice they're using, what are they doing with the funds that they're getting from C? They're using it to improve the land. Okay, so sometimes I know you might miss that. They're actually using and what do we know? What code section would then apply? I know what you're thinking, 1016, right? So that the basis of the property would be upwardly adjusted. Everyone agree? Because they're using funds to improve the property. The partners believe that they can sell the land for $450. Okay, very Pollyannish here. What results for tax and book purposes? Heck, they're right. They do sell for $450. Okay, now keep in mind, when this person comes on board, meaning C is not contributing property, right? C is contributing cash, and there's existing property, right? That has the aroma. Even though the original partners contributed cash, the property has appreciated value from $100,000 to $200,000, right? So even though it's not contributed property, it has the aroma of being contributed property, right? Everyone agree? As to A and B. Because you got a basis equal to 100, fair market value equal to 200, right? You have a new partner contributing cash. And in the book and the regulations, I just want to call this to your attention. This is on page 167. If you see that regulatory site and the examples on page 167, that's what that's all about. All right, so let's see that code that regulatory site and the examples in action.
What was it you said about adjusting the basis of land?
That the land is going to go up by 100,000, right? So I'm going to erase this, and let's start anew with this. So for tax purposes and for book purposes, what's our basis in the land? What's our basis in the land, guys? 200, right? Started at 100, but it went up to 200, right? Okay, maybe you guys were answering me, which is fair. What was the original basis? It was originally 100, but there was $100 of improvements, okay?
Excuse me. Are you asking on the basis as at the time the other partner came in?
Yeah.
Okay.
Okay, when he came in and made the improvement. Because, and I'll show you where I'm going with this. So the basis is 200, and we're told that it's sold for 450, right? What's the book value of the property at the time the new partner comes in? What's the book value of the property? Well, it was 200, but the partnership made $100,000 of improvements. Everyone agree? So the book value of the property, right, is $300,000. Agreed?
Wait, why was it 200 to start?
Because when the new partner came in, you and Tamara are partners, and I want to come in. You have a right to book up the value, right?
Okay.
Because truly, economically, you and Tamara each have $100,000 stake, so your capital accounts can be raised to 100. to $100,000 apiece. So the book value starts at $200,000, but there's $100,000 worth of improvements, and now we're going to sell it for $450. What's our tax gain? $250. What's our book gain? $150, right? All right. So let's go through A, B, and C and figure out how to allocate book and tax gain. A and B, what is their initial outside tax basis and capital accounts on day one that they form the enterprise, guys? 50 across the board. You like that email, right? Loving it, right? 50, 50, 50, 50. Everyone agree? C's not even part of the picture. Okay?
No activity during year one, nothing happened.
Okay? And then, what happens? C wants to join forces here, right? And we said that's an occasion under the regulations where you can book up your capital accounts, not your tax basis. But if I join forces, Dill and Tamara are going to want their capital accounts to go up because, heck, when I come in, their capital accounts are each 100. There's a building, right, worth $200,000, and they want to, right, reflect that, right? Everyone agree? So you can book up their capital accounts. Right, Amar? You understand that when I come aboard, they want to make sure their capital accounts reflect economic reality.
And that's why C has to contribute 100 to become.
That's why C is going to need to contribute $100,000 of cash. Everybody agree? C's contributing $100,000 in cash. Amber, you got that? Now, we could all hold hands together because we've been down this path before. Okay, so we're all ready to hold hands together, guys? Okay, holding hands. What are we going to do with that book gain? What are we going to do now with that book gain? This book game, we sell it for $450. What are we going to do with the book game? 50 each, right? Economically, we're 3 equal partners. Everyone agree? All right. Feels right? 50, 50, and 50. Okay? Because at the end of the day, we're going to take that 450 and just give it to the 3 of us, right? And Jonathan, what are we going to do with that tax gain?
C is a non-contributing. Sorry, I'll shut up.
Jonathan?
Allocate across, equally.
To say it loudly?
Allocated equally.
Sal, you agree?
Yeah.
Andrew's shaking his head no.
No.
Why not?
Because A, B have each have a 50,000 built-in.
Don't look at it that way. Do you mind? For my simpleton, Eric, you know how I think. Simple, right? So what's my mantra?
Give what they deserve.
Give them what they deserved, and who's the person who put what deserved? C is considered the non-contributing partner, right? Everyone agree? Even though there's no real, this is the reverse of the contributing, C should get what C deserves, right? C had a book gain of 50. C should be tagged with 50, right? Everyone agree? Give the non-contributing partner what he deserves. How much of the gain is left? Are we going to divvy up the tax gain? Go ahead.
Sorry, you lost me on the last part.
Okay.
Not to share the tax gain.
Well, you agree that this is the non-contributing part, C, right? And C had a $50 book gain, right? You
Yeah.
agree? And we got to give C, we have $250,000 under 1001 gain. So we'll give C the tax consequences associated with C's gain, right? But the other 200 is unaccounted for, right? So we'll give that to, I'll say, contributing partners. They're not really, but for artificial's sake, they are. So they get an extra $100,000 apiece. Did I screw this up?
You just wrote 150, that's all.
I apologize. 100, yes.
Okay.
Thank you, Ben. And Evan's a happy camper because it's straight up 150s, right? Callie?
Is the remainder split between A and B because they put equal amounts into the property? Is that the?
No, it's split because when C came on board, there was an embedded extra $100,000 a gain, right? They should be tagged with that extra $100,000 a gain, right? Because when C, in other words, when I came on board, I shouldn't have to deal with it. Dill and Tamara depreciated in their hands. They have to deal with the tax consequences. And their capital count went up by 50 and they were never tagged with the gain on that, right? So they're truly feeling $100,000 richer, they should pay the consequences of that.
I think her question is that if A and B contributed, say, 30-70 instead of 50-50, you would split the gain proportionally, right?
Yeah. Doesn't have to be 50-50, it depends on who contributed what. All right? All right, so this is not contributed property, but the concept is very similar. Do a lot of accountants and lawyers miss the boat on these things, guys? They do, but not you guys. All right? And if you want authority, I know Megan's looking for authority. It's exactly from where that regulatory site I cited you to, plus the example. Okay? All right, this is all found on page 167. Question C. Question C, by the way, guys, for my purposes, question C and question B, I don't truly know why the authors asked this question C is going to be, in my opinion, the exact same, that they're going to get to the same result. So I don't have a different answer to question C. Okay? Question A and question B and question C, I would say argue would come out with the same outcome. So for your notes, just leave it at that. Let's not dabble too much further. I believe that there's no election here. The way I read the regulations, they have to allocate it in this fashion, or else, if you look at question D, it says, what results on the sale of the land for $450 if the capital accounts of the partners are not adjusted when C joins the partnership? The agreement does not include any special allocation to reflect the built-in gain at the time C became a partner. And what the authors are alluding to here is that if they ignore the capital accounts, the problem D, they ignore the capital accounts and essentially A and B are, let's say, husband and wife, and taxpayer C is the child. Okay, everyone had the visual? Dill and Tamara, husband and wife, Solid is the child. Sorry guys, I'm you guys. And you want to get monies to me, okay? There's a regulation on point here. 704-1B2, 4 little I, F. I'll repeat. 704-1B2, for little I-F, that if, for some reason, we start off tax book, tax book, tax book, and we start off exactly what we said. 50-50, 50-50, 100-100. And we decided that we were going to take this book, that for book purposes, there was $150,000 worth of gain. Let me see if I... what ends up happening here is that, well, what the regulations are suggesting is that this $250,000 gets split 3 ways. That, like, we each got a K1 reflecting $83,000 of taxable gain that we just decided to split it. That doesn't work. That this would be considered a deemed gift from the husband and wife to the child, taxpayer C. Like, if they don't take into account the fact that there is at the time that C comes on board, that there is built-in gain in that property, there's either a deemed gift or disguised compensation to taxpayer C. If in some form or fashion, that when this property remember, when this property comes into being, it's got a $200,000 book value, but then there's going to be $100,000 worth of improvements. How do I say? So there's a total of $100,000 gain before it's even sold. And if that $100,000 of embedded gain is split 3 equal ways, somehow taxpayer C is being gifted money. Okay, if taxpayer C is entitled to the benefit of that $100,000, in husband and wife's hand, it went up by $100,000. If I, as the child, am able to derive an extra $33 worth of benefit from it, there must be some sort of disguised gift, or if I'm unrelated, okay, husband and wife, I'm unrelated, and I get an extra $33 out of that arrangement because I get to share equally in the built-in gain, well, then it must be disguised compensation. They're trying to compensate me maybe for services I render on behalf of the partnership. All right, so look, here's what I care about as we start flipping pages. I care about that everyone here can do the sale or exchange of contributed property. I care about the depreciation of property, that you can handle the traditional method and actually don't lose sleep, but maybe a simple remedial problem, remedial method. And if you can ignore the last problem, problem D, can you perhaps look at a reverse of a contributed property? What we did in problem B and C. And I said, for my purposes, problem B and C we're going to treat as one. All right, so that's the takeaway from thus far with this chapter. That's what simple depreciation, simple sale, and maybe one reverse. Go ahead.
So, I mean, I know you said what you just said, but for D, if the agreement doesn't actually say that, 704C1A overrides the partnership agreement anyway, right? It basically says
704C1A overrides of it. At the end of the day,
if they don't do it, then
and they don't honor it,
right.
They're saying the regulations make clear there's some other agenda going on here.
Okay.
It's either disguised compensation or a gift.
All right.
So if you ignore the regulation, there's nothing illegal about it. There's supposed to be other tax consequences.
Okay.
Amen.
And when you say reversal,
Reversal where in this problem there's no contributed property, right? They contributed cash, everyone contributed cash, right? So on the face of it, you say, hey, 704C1A can't apply. There's no contributed property. Everyone contributed cash. It's a clean partnership, but that's not true because the reverse principles of 704C1A come into being if a new partner joins. And the property that A and B originally held is treated as if de facto it was contributed property. Yeah.
That fair market value adjustment, is that required, or can you just take care of that on the sale?
You can just take care of it on the sale.
Okay.
I think most partners would want it taken care of because it's a reflection if you're A and B that you want your capital accounts to be adjusted appropriately.
Okay.
Go ahead.
I have a very basic question. So I'm struggling with the basis of the tax basis for ABC because when ABC contributed assets, that should be considered the basis for the partnership. I mean, the assets for the partnership.
Well, it is.
Right? And
Their original basis in the building is $100,000. Right? Right? They contributed cash of $100,000. The partnership bought a building for $100,000. So that's the inside tax basis. And then the partnership got an extra $100,000, made an improvement to the building. So that's why I went from $100,000 up to $200,000.
So we're talking about the basis of the partnership, the asset basis of the partnership, right?
Right? The inside tax basis.
Inside basis.
Yeah.
And then we have to.
In this case, coincidentally, it's also the outside basis to these partners. Now remember, the building has one basis. You don't break it down by 50, 50, and 100. It has one tax basis of 200,000, right? That's the inside basis. So we're looking here at the inside.
So for the midterm, we're just focusing on the traditional method and the remedial?
We're focusing on possibly all three methods. I just look at all three methods, guys. I don't want to limit your body of command. All right? All right? But if you get stuck, let me know. All right? So, I wish there was another board here for me to steal, but there isn't. And I don't think I can move this wall. Oh, look at this. Oh.
That was last week.
That was last week. Look at that.
Good to see you. Sorry, it's not to be clean.
All right. Moving on, because cost. All right. Partnership interest acquired by gift or purchase from a family member. Okay? Again, if you look at code section 704E, 704E, bear in mind, prior chapter said anything goes, right? Anything goes. This chapter is saying not so fast. And we know, anytime there's family members, what does Congress fear? What word? There's one word. Manipulation is fine. I had a synonym. Collusion. Collusion, right? That family members, one economic unit, says, in the case of any partnership, 704E, in the case of any partnership interest created by gift, the distributed share of the donee under the partnership agreement shall be includable in his gross income, okay? So that's, by the way, you receive a gift, right? Code section 102, not taxable. Everyone agree? 102A? And if you recall, code section 102B sort of says, well, if you earn income on that gift, right, it's not exempt from tax. You may or may not remember that, but that's not surprising, right? So if someone gives you a gift of stock, the dividends on that stock are not exempt from tax. Everyone agree? And 102B makes that clear. So So we're not surprised by the first part of the rule. It says, in the case, again, in the case of any partnership interest created by gift, the distributed share of the donee under the partnership agreement shall be includable in gross income. So nothing new under the sun there, except to the extent that such share is determined without allowance or reasonable compensation for services rendered to the partnership by the donor. So we're not going to honor what you do unless the donor gets reasonably compensated for his or her services. Sounds like Lucas Fiero, right? Which it is. So if the donor gives you a gift and then contributes services, the donor better be reasonably compensated for his or her efforts. That's regarding to services. And except to the extent that the portion of such share attributable to donated capital is proportionally greater than the share of the donor attributable to the donor's capital. Okay? So if there's contributed capital, if the donor contributed capital, the donor better get a fair return on that. It can't just contribute capital and all the earnings inure to someone other than to the donees. The donor's got to get a fair return, or else it's going to be deemed an additional gift. And, okay, you're having trouble following it, which is fine.
This is why people don't like lawyers.
This is why, Dale?
This is why people don't like lawyers.
It's hard to read, but once you see examples, and the regulations, by the way, guys, the regulations are not in our bridge code. They're not there. But the good news is, in yesteryear, I would have to Xerox it up and say, everyone pick it up at the end of class. I have the regulations. Now, if you just take a second and Google the regulations that the author cite us to, what's Cornell has all the regulatory sites in 1 second, right? Louis, you saw it. You can pick up, right? Alicia, you can pick up these regulatory sites. So if they're not in the back of the book, no excuse. You can't say, well, it's not in the back, couldn't read it, all right? It's easy to pick up. Don't get nervous there, Joe. All right, so again, what is the purpose of these rules? The purpose of these rules is straightforward. It's so that people cannot manipulate the allocations to give tax-free gifts or compensation to family members, okay? Here, we are only dealing with family members because Tamara asked a question at the beginning of the class when I raised the question and said, hey, is it a family member or not? And I said, in my fact pattern, it was irrelevant. But in this fact pattern, it is relevant, right? It's got to involve family members. And by the way, you might say, who's in your family? Good question. 704E2, the last sentence says, the quote-unquote family of any individual shall include only his spouse, ancestors, and lineal descendants. Okay? And certain trusts for their primary beneficiaries. So it does not, for example, include your siblings. I'm just calling that to your attention. So, and keep in mind, I have highlighted in red, at least in my book, on page 174, the first paragraph. It says, the central purpose of Code Section 704E1 is to ensure that income generated by a partnership is not improperly assigned to family members and others who receive their interests as gifts. It requires that the donor partner's services be adequately compensated and the rate of return on the donee's capital not exceed the rate of return on the donor's capital. Okay, that's what this all comes down to. That's it, that one paragraph. So on page 174, we have some quick problems. Let's put these to bed, and then we can get to the last segment of the chapter. Consider whether the following situations will be respected as a partnership under the Culbertson standard. That's a Supreme Court decision that said, essentially, look at the substance, not the form. Suppose the father is a lawyer who makes his son a contractor and daughter a student, partners in his partnership. Does that sound kosher? No one. That's not going to look like. That looks like they're just trying to allocate income. Everyone agree? That will not meet the standard. How about father's a lawyer, makes his daughter, who's a recent law school graduate, a partner? Will that be kosher? Yeah. I mean, they can join forces and have a law firm. And what happens if the father owns a building and he transfers the building along with the lease for partnership with the son and daughter as being members? And this will be okay as long as the son and daughter participate in the management, okay? So as long as they participate in some meaningful fashion in the management, this should be satisfactory.
What if father doesn't want to participate in the management?
I don't think that matters, Alicia. I think it matters more if the, okay, if the son and daughter are participating.
And that's because he gives the building and the lease, so basically everything's going to the kids, or?
I think he's remaining as a partner, so they're all 1/3 partners.
Oh, okay.
Okay? Question 2. Father owns a group of commercial rental properties which he transfers to a partnership with son and daughter who provide consideration for their 1/3 interest in the partnership. Assumes the partnership is respected for tax purposes. So he transfers commercial property and the son and daughter, I apologize, provide no consideration. Okay, so he's contributing the property and the children are not contributing anything. The income from the partnership is $90,000. What results if father rendered services worth $30,000 to the partnership, but the partnership agreement merely calls for splitting the income equally among the 3 partners, each partner actually receiving $30,000. So in this case, what's going to happen here? How much should father get allocated, guys?
30 plus.
30,000. Everybody agree under Lucas Fierro and under 704 E2 and E1? You should get the first 30, and what about the remaining 60? That should be split 3 ways, right? So he should be allocated 50, right, total, and each child allocated 20. And that's how the tax consequences should fall. If he isn't, I mean, the IRS could come back, say he's taxed on 50, and each of the children are taxed on 20, and then he's made a gift to them of anything that they end up more than 20. So for your notes, again, dad should be taxed on 50, each child 20. How about the next question? What happens if the father renders no services, but the agreement provides the income to be divided 20% to dad and 40% to each child?
Wait, I'm sorry, hold on 1 second. You said if they end up, could you repeat what you said about the deemed gift? How much would be?
Yeah, is that the father should be taxed on 50.
Right. And then the son and daughter should get 20 each.
They should be each taxed on 20.
Right.
If they end up with $30, it's as if the father gave each one of them a $10,000 gift.
Just a $10,000 gift, not as if he got all 9 and gifted them. Okay, got it.
Okay. Question B, which we just said, he renders no services, but he's going to get 20% to father and 30% to son and daughter. And this gets to the hard reading in this case, where, remember, father's contributing property. Okay? If you read 704E1, his rate of return should be no less than the rate of return of the donees, right? His rate of return should be no less than the rate of return of the donees. So here, what should the father actually get? He should get 30%. Everyone agree? Or $30,000. As it's orchestrated, they wanted to only be taxed on 18, and the children, who are probably in lower tax brackets, we're going to ignore the kiddie tax. So the IRS could come back and reassign income to dad and say, hey, you've got to be taxed on 30.
33.
30.
It's 90,000, right?
This
Ah,
90,000.
you're coming on there.
Yeah, dollars, not percent.
Remember that this overrides any partnership agreement, okay? Remember the prior chapter, I said with some small caveats, the sky's the limit. Everyone agree? But 704E, and we saw 704C1A, say no, what? I could add some explicatives, but I'll leave it. No blank way, right? Try to keep your attention, right, guys? Then you have your attention, you're there. You can't do it. You can't do it. Right, Yolanda? Can't do it, right? All right.
Excuse me. I'd like to take us back a little bit to E. You said if they share the 10 equally, they share the 9,000 equally, right? The extra 10,000 will be considered in each, but the father will still be taxed on 50,000, right?
Yes. Dad should be taxed on 50, each child on 20. In this problem B, dad should be taxed on 30, right? Because he should get no rate of return less than his children. Question C. What result if father renders services worth 30? The agreement is the same as part B. I mean, I don't know what the authors are driving at here, so I'm not going to lose sleep on this. If he renders services at 30, he should be taxed on 30. I'll leave it at that. You don't need to, let's not overcomplicate this. You should be taxed on the first 30, and then whatever else the agreement says, then they'll split the remaining 20, 20, 20. Question D, what result if the son renders services worth 30, the agreement is the same as part A above? Well, in this case, if the son renders $30,000 worth of services, he should be taxed on 30, right? The first 30, and then whatever remains should be split 3 equal ways. That's what 704E1 says. So son would be taxed on 50, dad on 20, daughter on 20. Kelly?
Isn't the father providing services here too?
I don't read it that way. There's nothing. It says the agreement. It doesn't say the father is rendering services worth 30. All right? So.
If he was, it would go 30.
Yeah, then it would go 30, 30, and then the 10. It would end up being 40, 40, 10. The daughter would be taxed on 10. Okay? Don't overcomplicate this, guys. Everyone should just be taxed on what they earn, is the bottom line. And question E, what results if son and daughter purchase their 1/2 interest from father at fair market value? The point of problem E is simply to say, if you look at 704E2, in this context, a purchase is treated as the same as a gift. So you get the same results. You can't end run the statute by having a purchase.
I have a question.
Shoot.
Does it matter what's the age of the children in this?
No, it does not matter. Because a member of a family is not defined by age. Right?
Because you were mentioning kiddie tax before.
The kiddie tax, yeah, but that's just a prophylactic measure to protect the progressive rate structure. All right? So the message here, guys, is not a message you're going to be unfamiliar with. The message is anytime you have members of a family and you have, we've seen it before, sales or exchanges, Code Section 267, for example, they disallow the loss. Or conversely, if you have sales of depreciable property to a related person, Code Section 1239 treats it as an ordinary income. One more context. Here you see transactions between partners who are family members. You do not have the same flexibility as you did have in Chapter 4 of our textbook, right? You can't, the code doesn't say, oh, however you want to allocate it, just keep your capital accounts, we'll respect it. No, doesn't fly, right? Everyone agree? We could have substantial economic effect between and among family members. 704E1 says we don't care. All right, everyone got that? All right.
They're doomed for life.
Oh, what?
They're doomed for life. Like,
I don't say they're doomed for life. They're joined at the hip for life. Okay, Alicia? You are blood. You are blood.
And it's possible that one child gets more than the other. Is it possible? No, they all have to. Like if they have 2 kids, if he has 2 kids and he wants to give more to the daughter instead of
I
son.
mean, you could give more to the daughter than to the son, but you got it for tax purposes. Just be careful. Let me just, Ashley, you had a question?
Is the end result that a family member cannot have substantial economic effect?
You can, but you can't play games with your allocations that aren't reflective of reality. Like if the father renders services, he or she, in this case, he has to be compensated for his services. And the rate of return has to get a fair rate of return on contributed property. All right? Okay, we got 25 minutes to cover the last section, so let's keep going. Okay? The general rule, remember, partners' interest in a partnership may vary over the course of the year. It's not written in stone that everyone at the beginning of the year may not be the same as the end of the year. Everyone agree? May not be the same. And that being the case, we have to take that into account. And 706 C2, just keep open. 706, if you recall, helped us determine the tax year. And 706 C talks about closing of the partnership year. Talks about the fact that if you don't dispose of your entire interest, the partnership year doesn't close. If you dispose of your entire interest, okay, the partnership year does close. Okay, I'll repeat that. If you retain any portion of your partnership interest, the partnership year doesn't close. If you sell the entirety of your interest or it's disposed of, your partnership year does close. And Code Section 706D determines what is your distributed share if your interest changes. And the regulations, right, Megan, you see the regulations on page 175? Those, they're not long, they're not hard. They give you 2 options on how you're going to handle this. One is more accurate than the other. The default method is what's called the interim closing the books method. The interim closing the books method, and it creates segments of time. Segments of time, and you allocate income and deductions to those segments of when they arise. In contrast, there's a more arbitrary method known as the pro rata method, where you just look at the number of days the partner holds the interest, and based on those number of days, you just allocate the income proportionally based on the number of days. Okay? So we have 2 methods here. Interim closing the book method and pro rata method. Interim is more accurate, pro rata method less accurate.
Question.
Awesome.
Does the interim method use the physical or calendar year?
It depends. There's no, you can use fiscal or calendar year. Whatever the partnership's on will be determined. Okay? And we will see that under 706E2 that there's certain cash method items that have to be treated as accrual. 706 D2, in certain instances, okay, have to, if you look at D2A, have to be treated as as if it's on the accrual method. And if you look at D2C, certain things that happen outside the tax year are either going to be treated as happening the first day of the tax year or the last day of the tax year. There's certain events that if you prepay certain things, that it may be deemed to happen the first day of the tax year, or if you pay expenses for the next year, may be deemed to have happened at the very last day of the tax year. Well, we'll see examples of this in a moment. And just, you can't circumvent these rules by having a so-called tiered partnership arrangement. You can't circumvent these rules by having a tiered partnership arrangement. Okay? All right. We don't have the luxury of time, so let's just look at, I think you'll be able to graphically see this by looking at this on page 180. There's question 1 really illustrates this. So let's just get right to it so we can finish up for the night. We have ABC partnership has 3 partners. Each have an equal interest in the partnership, capital, profits, and losses. Payoff expenses incurred by the partnership. C contributed additional capital on Halloween of all days, right? As a result of C's contribution, right, the partner's interest in the profits, capitals, and losses change from 25% to A, 25% to B, and 50% to C, right? Because C is going to make a massive contribution, but it's going to change each one's interest, right? C is going to go upward, and A and B are going to become diluted, right? Partnership has $24,000 of losses in the current year, and they use the pro rata method. How will the losses be allocated?
Did I ever say you have to use a certain method, a certain thing, or is it?
No, you have a choice.
Okay.
Okay, so we have profits, losses, months held, computation, and distributive share. Well, A had a profits interest, A and B, we'll group them together as if they're one, because, right, their beta is the same. They had a 1/3 interest, right, for 10 months, and at a 25% interest for 2 months, right? So last I checked, the numerator is 10/12, and they had a 1/3 interest, and there's $24,000, and then they had 2/12 times 1/4, right? Times 24 equals 6,667 equals 1,000. This is the profits and losses percentage. This is the months held, computation, distributive share.
Going all the way down for A and B.
It's true. It's the same for A and B. This is A and B. This is not B. This is not A. In other words, this is true for A and B. So A and B would each report losses, right? A 7,667. And taxpayer C, likewise, starts off at 33 1/3. What do you think this is going to be? 10 months, 10/12 times 1/3 times 24 equals what? 6,667. Bob holds 50%, right? For 2 months. 2/12 times 1/2 times 24 equals 2,000. That's it. It's rather simple math. You know, all we're doing is breaking it down monthly, by the month. And if you want, this is the tax consequences to A. This is the tax consequence to C. And then, hint, hint in your notes if it makes it easier, the same tax consequences befall taxpayer B. Okay, I think it may be easier to read it that way. Questions?
Can you read the calculation? 10 times?
10/12 times 1/3 times 24. That's the amount of the loss, right? 2/12 times 1/4 times 24. Okay? You can take a look afterwards. I just want to make sure we get through all this. Question B. What if the results, or what results if the facts are the same as A above, except that the entire $24,000 loss was incurred during the first half of the year, but the expenses that created the loss were paid November 15th, right after October 31st, right? Everybody agree? But the loss is incurred in the earlier part of the year, right? And we're a cash method taxpayer, and we're paying them in the second half. And, you know, they're getting the money to pay the expenses because C is making a capital contribution. And the partnership this time uses the interim closing of the books method. How is that $24,000 loss going to be split?
By 3.
Say again?
By 3.
By 3, right? It would be $8,000 apiece because it's the interim closing the books. One second, I just want to look at one thing. Excuse me, they're on the accrual method, right? It's not the cash method. Everyone see they're on the accrual method? So the expenses arose in the first half of the year, right? When they were each 1/3 partners. So the expenses, right, by October 31st, there's minus 24,000. And we're closing the books, right? October 31st, before we move on to the second part. Doesn't matter when it's paid, right? If you're an accrual method taxpayer, it doesn't matter. So therefore, it would be -8. Your answer is -8 to A, B, and C here. Contrast question C. Assume the facts are the same in A, except the partnership, now we're moving on to a cash method, okay? The partnership uses the interim closing of the books method, allocation in all income and deduction items other than $24,000 loss were received or incurred ratably throughout the year. What result if the loss is the result of payment on November 15th of $24,000 to rent an office for the entire year? What do we do about rent payments? When are they deemed? Now, we're told it was payment of November 15th. Cash method, usually, if you're cash method, it's when you pay, right? But if you look at code section 706D2B, take a look. 706D2B, it says treat items, okay, payments for services or for use of property. That's another way of saying rent payments, as if they were on the accrual method, right? As if those expenses happened ratably throughout the year. Everyone see that? It forces you, even if you're a cash method taxpayer, to treat that expense as if you're an accrual method taxpayer. What's the answer then? Same as above. Same as in A above, which is right there on the board.
But A's using the duration method, and they're saying interim closing.
Yeah, but remember, it doesn't matter here because it's effectively that 24,000 is happening throughout the whole year, right? Because you're on the accrual method, it doesn't matter. Question 2, little one. The partnership breaks even for the year, but the loss is the result of a settlement of a breach of contract brought by plaintiff. The payment is made on June 1st. The settlement is made on June 1st, and the payment is made November 15th. So now we have the interim closing of the books method, right? And the payment is being made in the second half of the year, meaning in November, after October 31st, right? So how does that get split? 25, 25, 50, right? So that's how you would divvy it up, 25, 25, 50.
And that's because of cash basis, because even though they knew what the settlement was going to be on June 1st.
Doesn't matter, they're cash method. All right? So in that case, it'd be 6, 6, and 12. 6, 6, and 12. 3 little I. The loss in one little I above is the result of a payment on March 1st of the current year of $24,000 rent due from the prior year. So they're paying prior year's rent. Look at code section 706 D2A. D2A. If during the taxable year of the partnership there is a change in the partnership, the interest in the partnership, one second. D2A, 1 second.
D2D?
No, we got to go down to capital C, 1 little I. We know this should have been deducted in the prior period. Right? Everyone agree? This should have been deducted in the prior year. And look at C, capital letter C, says if any portion of any allocable cash method payment is attributable to any period before the beginning of the tax year, such portion shall be assigned under paragraph A.I. to the first day of the taxable year. Okay? So it's going to be assigned this deduction to the first day, no matter when it's paid. If you look at capital letter D, if any portion of the deductible cash method item is assigned under subparagraph C to the first day of any taxable year, such portion shall be allocated among persons who are partners in the partnership during the period to which such portion is attributable in accordance with their varying interests in the partnership during such period. First day of the year, what were their interests, guys? A third apiece, so they each would get $8,000 worth of deductions. Finally, question 2. We have a partnership. This is a tiered partnership arrangement. We have partnership A, B, which is owned by A and B, right? There's no surprise there. A and B are individuals. And this partnership owns an 75% interest in another partnership, a lower tier partnership, that has a $16,000 loss. That is owned by partner C. It owns 25% of this lower tier. And partner D wants to come on board. Partner D wants to come on board. So we say AB is a 75% partnership in ABC, in which C owns the other 25%. So this is ABC partnership. The lower tier partnership is the ABC partnership. That partnership has a $16,000 loss. D becomes a 1/3 partner in AB partnership on December 1st by making cash contribution. How will the ABC loss be allocated if AB, now ABD, uses the proration method and the interim closing of the book method? So there's another question mark. Whether it uses the proration method or the interim closing of the books method. Okay? Now the payment is made, right? What's 75% of 16,000, guys? 75% of 16,000, last I checked, is 12, right? So A, B, and now D. D would like to get 4,000 of that. Everyone agree? D would like to get 4,000 of that. Now the question is, can D get 4,000? Now, certainly under the proration method, guys, do you remember what happens here? Let's go through this. A and B are treated the same. A and B are treated the same. A has 50% interest, right? Times 11/12 of the year, right? 11/12 of the year times 12,000, right? Because he's a 50% partner for 11/12, so that's 12,000. So that is equal to how much? $5,500. Okay, 1/2 times 11/12 times 12,000, and he is a 1/3 partner times 1/12 times 12,000. That equals $333. So the total loss is $5,833. D is a 1/3 partner, right? For how long, guys? 1 month over, 1 over 12 times 12,000 equals $333. So A and B each can deduct $5,833. D can deduct $333. Okay? That's all we did. It's very similar to what we did up here, right? Months held, your computation, and that's the outcome. Now, under the proration method, excuse me, let me rephrase this. This is the proration method. In the interim closing of the books method, B would like to get all $4,000 of the loss, right? We'd like that A, B, and C, A, B, and D each get 4,000, right? Because cash method, that's when the payment was made, right? And what Code Section 706D3, Code Section 706D3 says you can't do that. If you have a tiered partnership arrangement, it forces this result. It forces a proration result. You can't manipulate it by dropping a lower tier partnership. So Congress devised Code Section 706D3 to put the brakes on taxpayers trying to manipulate the system. Amber?
I have a question on the proration.
Yeah.
Where did you get the half?
They were 50, A and B were 50-50. I don't have taxpayer B here.
It says A and B equally own 2/3.
They equal, A and B equal A and this partnership, 50-50. That's where I got the 1/2 from. Okay? I didn't put the same results, whatever happened to A happened to B.
Right.
You know what, Amber, take a look and I'll stay here after class. You can ask me after class, okay? Eddie?
So both calculations, the $5,800 and something is for A, right?
This is for A and B.
That's the same applies to B.
Absolutely. All right, guys, for the exam, keep in mind, next week I need everyone here at 6 o'clock sharp. I need you having post restroom use. And I need everyone to be able to give me 200% of their attention, but Angela has a very important question.
You said at the beginning the exam goes up to page 215.
No, the exam only goes to what we covered tonight.
Okay.
Okay? So if you do have any questions, I'll be available. Good luck studying, and I'll see everyone here next week, 6 o'clock sharp.
Tell us what happened.